Welcome to the IB Investor channel. In this video, we'll dig into Lifco, a Swedish serial acquirer listed on the Swedish stock exchange. Lifco was founded in Sweden in the year 1946. It is owned and operated by Carl Bennett, who owns 50% of the capital and 69% of the voting rights. The company has 81 billion kroners market cap, or 7.4 billion US dollars. It offers a quite low dividend yield at 1% currently, but it grows fast. The stock has returned 26% CAGR for the past 9 years. And as of now, there are more than 21,000 shareholders and counting. Even though the company has been around for many years, it actually listed on the Swedish stock exchange here in 2014. So it doesn't have a very long track record as a listed company. However, they have acquired more than 100 companies currently, and there are more than 6,500 employees in the company. Ever since 2006, the company has produced sales over 13.9% per annum, and the EBITDA growth has been more than 19% a year since 2006. Here we can see an overview on the stock return. Unfortunately, this company doesn't have a calculator on their own web page, so we're going to have to make our own calculations here. But as I mentioned before, the company has only been listed since 2014, so it doesn't have a great track record. But over this period of time, the return has been a total of 671%, and the CAGR for these past 9 years has been almost 26%, which is way above the 6RX, which has produced roughly 10% over this period. The company also currently trades at a 25% or 25p multiple, basically price to earnings ratio. We can also see that this company has had periods of overvaluations, I would say, in my opinion. There's been some pretty high highs here in recent time, but the stock has come down almost 30% since the all-time high, and it looks much better now compared to what it did just a few months ago. Now on this slide, we'll see the operating performance, or rather management's performance, I would say, for the company. Starting on the right side here, for the trailing 12 months, we can see that management has performed a double-digit return on equity, almost 23%. And we can also see that the track record going back a few years, it's been double digits all across the board. So management has done a pretty good job here, keeping the numbers very high. If we look at the return on invested capital, it's also double digits all across the board, looking back, and also the most recent quarter here. So it looks good. Nothing really special to say here, except that management is doing a good job here. If we continue here, we'll just look at the margins real quick, and we can see that the operating margins here are really high at 19.34%, which is good for this type of companies that they're running. Got to remember that they do have some industrial companies here in their portfolio as well, so achieving this margin is really good. So, and we can see across the board here that the margin has been double digits all the way through for the operating margin. But I'm not sure whether this high margin is sustainable or not, because it is quite a high number, and yeah, we'll see. Anyways, the net margin here, lower obviously, but still double digit, which is still a good figure as well, I would say. And we can see that the net margin has been double-digit figures for all across the board here, even going back a few years here as well. So management has done a good job here, increasing prices towards their customers, which is good to see that they have this sort of pricing power. It could also be the case, I haven't really read all the reports here, but it could be the case that they have acquired some companies over the past years that has also had higher margins compared to their other businesses, also expanding the margin that way, probably, but I don't know. And as per usual, I included a dividend chart here for the dividend guys. And we can see here it's a very strong dividend track record with increased dividends each and every year. And the most recent hike was 20%. So it's been really, really strong. And the exception here is that Lifco was one of those companies that actually did have a dividend during 2020. So I believe that management had really strong confidence in the business that they're running. So they did pay out the dividend even for the COVID year, which is obviously a pretty good sign that management, even though the world were in shambles, I was about to say, but they still had confidence in paying this out, which is good. The most recent quarter looked really good, and I think that's probably one of the highlights here that I see as a risk. So basically, the company has more than 200 subsidiaries that they have to manage. And obviously, the same question here as I posed with Indutrade is how far can it go and how far can it grow? 200 companies, that's a lot of companies that they have to manage. And I'm not sure, I understand that they certainly have divided into business units and so on, where they have really strong local, not just presence, but also leadership and management. But at some point, when you have 1,000 companies, it's going to be tough at some point to really drive margins and so on at the outer edges of the company. Next point is the net debt to EBITDA, which is 1.6 times. Obviously in a time like this, it's good to have 0 at your balance sheet, but I guess it's not really possible for most companies, since especially for serial acquirer, they may not have enough cash flows on hand to make the acquisitions that they want. But yeah, and then of course the high EBITDA margin at just above 23% in the most recent quarter. I think the risk here is that the same question, basically, how high can it go? Can it really go higher, or is the only way downwards from here? It is a tough call to make. I can't make that call, but considering most of the numbers are running at all-time highs, it's tough to say. So certainly a risk that I think that the margins can be under pressure in the coming quarters rather than expanding. Now for the upside of the stock, the company has a really strong track record of dividends and dividend hikes. So basically, ever since it's been as a listed company, they have raised their dividends every year. The stock also trades at a much better multiple right now compared to what it did a few months ago. We've seen a drawback or a fall of almost 30% from the all-time high numbers, which obviously offers a little bit more margin of safety for the investors. We also see that the net debt to EBITDA is quite low currently compared to the past few years. They currently have 1.6 times here, so this opens up for the possibility to continue to acquire new companies. It's also owner operated, which means that Carl Bennett, who is the majority owner here, he's a powerful owner with good connections across the Swedish financial industry, and I'm certain that he can help this company pulling some strings and so on whenever it's needed. And he'll probably back this company if it comes under pressure from financial stress or something like this. So I'm pretty sure that this company is well taken care of with strong ownership here from Carl Bennett. All right, this was everything for this presentation. If you liked the video, please hit the like button below. And if you wish to see more videos in the future, please hit the subscribe button below. Thank you very much. Bye-bye.